Well, hopefully everyone has been able to join the Zoom session at this point, and thank you very much for taking the time to join. My name is Stephen Kinsella from the University of Limerick. I'm the chair of the session and one of the co-organizers of this conference. Please bear with us if there are some technical difficulties. This is the first session of us trying to do this, and so there may be some unforeseen issues as we go along, but the hope is that we bring you some of the top experts in the world on the issue of the macroeconomy and COVID-19. And really my job is to just introduce them and to collate questions. So when you ask a question, you will be sending it to me in the chat function. So just send me a direct message through the chat function, and I'll then relay those questions to the panelists at the end of their remarks. The panelists will speak for 15 minutes each, and then we'll have time for questions. We have three distinguished speakers today. The first speaker is Professor Michael McMahon from the University of Oxford. He's also a member of the Fiscal Advisory Council of Ireland. The second speaker will be Sharon Donnery, the Deputy Governor of the Central Bank of Ireland. And the third speaker will be Beata Javorcik, who is the Chief Economist of the European Bank for Reconstruction and Development and also Professor of Economics at the University of Oxford. We're very, very grateful that you have taken the time to speak with us today. Again, thank you for your remarks and your expertise. It's a very challenging time, so we are thankful. Can I ask then, Professor McMahon, can you talk with your remarks, please?
Yep, thank you. Hopefully people can hear me. And I have shared my screen, so hopefully my slides are visible. Yeah, thanks to Stephen, Liam, Orla, and Philip, or I think it's Philip as well, who organized this at such short notice. I'm going to apply the usual disclaimer here that these are my views. They do not necessarily represent anybody else's, and in particular may or may not represent the views of other members of the Irish Fiscal Advisory Council. I have based my presentation around 7 questions. I have 15 minutes, so I'll be very quick on them. And although the title of the session was about post-COVID macroeconomy, I'm actually going to start in the here and now. I'm going to ask 2 questions. One, was an immediate, a sudden recession inevitable? And to ask what we know so far about how bad it is. And then I'll switch to a slightly longer view, but not a long-term view necessarily. I'll think about the macroeconomy post-COVID, but ask what the recession might look like over the next 1 to 3 years. I'll mention some longer-term potential changes, but I think Beata is going to touch on those, so I'm going to defer to her expertise on this. And then I'll finish by thinking about the appropriate macro policy response. And again, one of the questions that people should be asking is, what should monetary policy do? Again, I shall defer to Sharon's presentation, as I believe she will cover that much more comprehensively than I will. And I will ask a few questions about how fiscal policy should respond both immediately and beyond the health crisis. So let me go on. Wasn't a recession inevitable? I actually am going to say words I never thought I would be saying, but actually rather than inevitable, I think we have to accept that this recession is desirable. So in particular, this, whether you call it the Great Cessation, the Great Lockdown, whatever, this is a public health response. This is a public health necessity. There's this chart from some work the CPR have been doing. It comes originally from the chapter that Pierre-Olivier Garinchas developed, but this idea of the effect of, as you flatten the medical curve, the steps necessary to do that necessarily make the economic crisis worse. But like I say, I think there is very good reason to accept that we both need and want to have some form of lockdown such that we don't overwhelm the health system, we don't cause greater long-term damage to the economic structure, and therefore some form of recession or slowdown was yes, it was inevitable, but also it's desirable. Very unusual thing for an economist to say. How bad is it? Well, we're still finding out because we're still living in the moment, but this is from just over a week ago. This is the Central Statistics Office March unemployment numbers. And you can already see by the standard seasonally adjusted figures, so these numbers here, from February of an unemployment rate, a low unemployment rate of 4.8%, the official rate jumped up already by 0.6 percentage points, which is relatively quick and large. But you have to also remember that most of March, or at least the early part of March, things were operating much more close to normal. And they have come out with a COVID-19 adjusted unemployment rate already for March. And again, with the caveat that a lot of March was operating much closer to normal. And that number is jumping up to 16.5. So that is bad. Just 16.5 is bad as a number if that were the unemployment rate. But it's particularly bad to think that within the space of 1 month, we could go from about 5% to over 16%. So this is as far as a sort of a lockdown, shutdown, recession. The speed of this and the widespread effect across sectors is what is really unprecedented. There are some things, and I think Sharon will use this. This is the data from Hopkins and Sherman. This is a Central Bank of Ireland analysis using payment systems data. And you can see over March how at the early part of March, both debit card transactions were looking relatively stable initially, up until about St. Patrick's Day, just after the further closures of bars and pubs. And from there, even debit card and credit card spending is down more than 30% from the first week of March. And if you look at ATM withdrawals, and obviously we were encouraged not to use cash because of the health effects of transmitting the virus, they're down over 50%. And that's only just into the start of April. And one of the amazing things about this type of high frequency data is the ability to analyze these things. You know, I think the other thing that we should think when thinking about how bad it is to think about the inequality aspects of this lockdown. And so this is data, this is actually from the UK, but from the Resolution Foundation, but it shows across, so each of these represents sort of a 5% of the workforce. So this number 1 would be the lowest paid 5% of the workforce. The 20 would be the highest paid percentage of the workforce. And this is the fraction of that group who are able to essentially do all their work from home. And you can see that if you mandate that people have to work from home, this is not great even for the richest, because these numbers suggest only about half of the richest groups can work entirely from home. But if you go down to the poorest sections of society, you can see that that fraction is much, much lower. And so not being able to go to work really for a lot of people will mean no income at all. So there is an inequality aspect there. There's also clearly inequality across sectors. Certain sectors, and this data comes from Spain, again, transactional data, so it's by day. This is the market share of transactions by day in the Spanish economy using BBVA data. It comes from Carvalho and co-authors, just released. And you can see, so food is now what most people are spending their money on. So transactions are down, but you know, bars and restaurants, it's big drop from about 20% to a small fraction doing takeaway, and a number of other sectors, travel, real estate, leisure and entertainment, all getting badly hit. So there's a number of dimensions of inequality that you would want to also think about. How bad will it be? So going to the more near future, there are a number of questions, and I'm very sorry, I'm going to answer this like an economist. The answer is it depends. And it depends on lots of things. There are lots of judgments that need to be made, lots of things. You know, when lockdown restrictions are lifted, whether that's at the end in May, sometime later in May, June, whatever, how people react, what's been the scale of the income loss, how does their changing behavior react? Are there mental health impacts that make people scared to go out? Do people become fearful of going to pubs, restaurants, clubs, sporting events? You know, long-term scarring issues on both education and on firm insolvencies. what is the longer term policy response? There are just a huge number of big uncertainties. So, it does depend. I know economists say that all the time, but it really does. And in particular, this time, uncertainty is everywhere. And to every forecast or scenario, whatever you want to call it, there is a huge amount of uncertainty, which means that there are both upside and downside risks to any projections that you see. So I decided to sort of lay this out. I didn't want to give actual data, so I've put an illustrative case. Here's an example of an illustrative case where the economy had no COVID-19, it continued to grow, and this is what GDP path would look like if it just grew at about a 5% growth rate. So it's an index of 100 in January 19. So this is the sort of nice economy carrying on. We all carry on as normal. Now, clearly, COVID-19 has happened sort of taking off in March, as I showed, and affects obviously into April, likely May and beyond. But the question is how beyond? So the most optimistic you could imagine would be what economists would call pure intertemporal substitution. That would look like this. This would be a world where, yes, in the period of part of March and into April and May and then back into June, we have to stop doing things and the economy might contract. It might contract over those periods by 40, 50%, who knows? But if this is all stuff that once May, June comes along and lockdown is lifted, we all go back and we do all the things that we were going to do anyway. I always remember Danny Quat telling me once that the most volatile that the economy is on a daily and a weekly basis. Nighttime, most businesses shut down for a number of hours, but then can restart again the next day. If that were the case, and this was just swapping consumption from March, April and shifting it into the summer, overall, the sum under these areas is essentially the same. The economy total amount of output would be the same. That would be the most optimistic. I am not under the belief that that is what we are going to see. A less optimistic, but still what people would call the V-shaped recovery was, yes, we lock down, and then afterwards, while we don't make up the losses, we go right back to the level that we were at. So V-shaped, or, actually the longer the lockdown goes on, it looks more like a U. But again, that's a fairly optimistic scenario, one where once the lockdown is lifted and people stop worrying about this, we go straight back to doing what we would have been doing in the absence of this virus. This is again from that Spanish data. You can see for Spanish nationals, actually their transactions were holding up pretty much until lockdown and then dropped about 50%. So a big uncertainty, a big question is, will behavior revert as quickly right back? So when lockdown is lifted, we go back. And Spanish, different areas of Spain are starting to release lockdown. So hopefully these data, when they come out, will be able to shed some light on that. But that's a huge uncertainty. Here's what I call the swoosh, because of the US sports manufacturer, who I won't give advertising to beyond saying the swoosh. This would be a world where, yes, we lock down, and gradually over a period, we return back to the normal path. But remember, everything between the blue line and the green line is then lost activity, is lost output. And in this example, I did it such that we would get back to about where we were at the end of 2021. It could be faster, it could be longer. The last one is one where there's some form of hysteresis or permanent loss of output. And again, this you could imagine relates to businesses that close down and just can never restart, industries that change, maybe behaviorally, we change what we do, we stop eating out as much, we replace all of our what were human interactions with Zoom calls, and we never actually see each other again, so the bar and restaurant industry gets badly hit. Again, this is one where I've done it as a 20% fall in output permanently. And so we get a sort of what looks like a slow adjustment back, but then we just never get back to where we would have been. Here's all of them together. They imply very, very different effects on the Irish economy and on any economy that's going through this. And the truth is, we really just don't know yet, as we are in this area here, just at the very start of it. We still don't know how deep it will be. We don't know how long it will go on. And we really don't know what the eventual recovery will look like. So again, that's the uncertainty about it. So these are some of the things, will we commute less? Will we travel less for business? Will we do, will globalization stop? Will people, stop wanting to do international supply chains. For an open economy like Ireland, this could be really a big game changer into the sort of what the future looks like. But as I said, I'll leave that to Beata to sort of discuss. So let me quickly finish with the what should policy do. So starting with monetary policy, again, I'll defer to Sharon on this, but you know, at least in the initial phase, I think the lender of last resort function is key. And beyond that, you know, monetary conditions still remain very favorable. In this first lockdown phase, it's not that we're looking for a traditional stimulus, but you know, support of fiscal policy responses in the immediate term, and then support for the recovery going forward. In many ways, the ECB is already doing a lot of that, so sort of keep going, keep doing it. I also have an aside, which is I think the banking sector, which of course was much maligned after the financial crisis in 2009-10, you know, I do think they have a role in passing on favorable conditions and supporting the real economy in this, and maybe rebuilding some of their capital with a wider public. But let me switch quickly to fiscal policy, since I think that's why I was asked to talk. You know, I've got to quote Eddie Casey, who's probably listening. It had an op-ed on this. You know, this is a time to be bold. This is a whatever it takes moment. In the immediate stuff, in the immediate moments, I think the three priority areas are, of course, to support the health sector, fight the virus, protect life, protect the lives of doctors, nurses, care workers, etc. Support individuals who have been affected by the cessation of work, the lockdown, and support employers so that there are jobs to go back to once we get through the initial health crisis. So I think that's the three priority areas that fiscal policy can respond on and is responding on. I mean, governments are taking unprecedented action. Of course, the implication of the lockdown is that revenue will go down, tax revenue will go down, and expenditure is going up. This means that for Ireland, from a small projected surplus and a surplus last year, the deficit in 2020 is likely to grow and potentially grow substantially. Now, some of you will be thinking, me in particular, advising that this is the right thing to do means that the sub-editors got it right. This is what the Independent wrote when I was appointed to the Fiscal Council. I still don't really know how I got labeled a deficit-friendly economist necessarily, but I do think that this is exactly the right time to be bold, and here's some reasons why. You know, the whole point of fiscal discipline is it buys the freedom to act when necessary. So Andrew Scott at London Business School, I've seen him say this, he's a friend of mine, I've seen him say this a number of times. The best way to pay for a once in 50 years event is over 50 years. That's what deficits and debt can do. The other thing to mention is, of course, the Fiscal Responsibility Act that established the Irish Fiscal Council does have an exceptional circumstances clause. I think we would all agree that these are exceptional circumstances. And Ireland has actually had quite favourable debt dynamics of late. Interest rates have been low on our debt, and we've been experiencing good growth rates. Even with the hard Brexit assumed in the last budget, the debt ratio to GNI star or even to GDP was projected to fall over the budget period because of these favourable debt dynamics. If we act properly, we can ensure that those debt dynamics remain favourable, and that will help Ireland to recover from whatever debt gets built up in the immediate response. And the other thing to mention is NTMA, the debt funding agency in Ireland, their pre-funding strategy has actually meant that Ireland has plenty of cash reserves, has been able to raise funds at low rates, and actually therefore has the space to provide these initial supports. Okay, last question. What about fiscal policy beyond the health crisis? Almost certainly, like I say, I don't know any economist that says they know for certain what the economy will look like after the health crisis is some form of charlatan. You know, I think we will look somewhat more like the swoosh or even the more permanent hysteresis type profile. We will take a while to recover, and therefore a traditional economic stimulus will be required. Fiscal policy will also be challenged in Ireland because with the formation of a new government, when it happens, they will have their own priorities. And these were priorities that are both thrown up by the recent election, but also thrown up by the health crisis. And so in order to ensure fiscal sustainability, there will need to be tough choices. There will need to be the normal business of monitoring will continue, and you know, fiscal sustainability will have to go back to the sort of top of the agenda when making these decisions on fiscal policy. Okay, so these are my questions. Was it inevitable? How bad is it? How bad will it be? Key uncertainties. What are the longer term challenges or changes that we might face? What should monetary policy do? What should immediate fiscal response be? What about fiscal policy beyond the health crisis? These are the answers. I think it's desirable. It's bad. We still don't know exactly how bad, but it's also unequally felt. So we need to, while it's desirable, we need to think about those when designing policy. We have no real idea. A lot of uncertainty about what's going to happen after the health crisis ends. There's a lot of uncertainty about when the health crisis will end. There's lots of possible longer term changes that Beata will talk about, I'm sure. Monetary policy needs to continue doing what it's doing. You know, in terms of fiscal policy, the immediate response is a whatever it takes moment. Health, people, operations all need to be supported. And in the future, I think we're going to be back to thinking about long, tough choices to make. I'll leave it there.
Michael, thank you very much for that. That was both comprehensive and enlightening. I really enjoyed the comparisons and the thought exercise. It was really good. Mark, if you're listening, can you please put Sharon's slides on? And is Sharon Donnery ready to speak?
Yeah, I'm here, Stephen. Hopefully you can hear me.
Okay, wonderful. Sharon, thank you very much for taking the time to speak, and the virtual floor is yours.
So thanks very much, and sorry for being slightly delayed. The best laid plans, of course. I checked all my technology yesterday and then let me down this morning. So thanks also to Michael for stepping in when I wasn't quite ready. And thanks also for the invitation. I think going back to the points Michael has made about just how uncertain times are for everybody, I think, as those businesses, for us policymakers and everybody else, it's really great to actually have an opportunity to kind of get together and hear some of the views and debates. And that's particularly important for us. I can hear the opinion of others and to kind of take that into account when we're considering some of the policy choices that we have to make. So I probably touched up the things that Michael mentioned already, but maybe try to give a bit more perspective from the central bank's point of view, and then of course how to pick up on some of the points in the questions at the end. So one of the things that I've been asked a lot about over the last few weeks is how this is the same as or differs from the financial crisis and the effects that we might see. And I suppose it goes back to what Michael touched on there, that of course this is a public health emergency first and foremost. I think you'll realise that when you're in a scenario where, you know, the name of the chief medical officer is publicly known, a kind of familiar household name, you're in a very different scenario to the one that we were in previously. I think we're very conscious of that in the bank, while many of the decisions that we are taking ultimately affect the economy and are trying to support the economy through this very difficult time. It's clearly a crisis of a very different form, a very different type, and will potentially affect the economy and indeed the financial system in a very different way, and obviously needs a very different response. So if we turn to the first slide there, just what I'm going to talk about today in terms of my outline, I'll pick up a couple of the points that Michael has talked about in terms of understanding maybe some of the macroeconomic effects, particularly on the Irish economy. We have recently published our quarterly bulletin, which includes a number of scenarios, I would say, kind of rather the forecasts, so I'll talk a little bit about them. We are working very hard to try and develop some high frequency, real-time indicators as well to help people understand what's going on in the economy. I'll talk a little bit about that. I'll talk then at some of the policies that we've implemented over the last number of weeks, which are relevant both for the economy but also for the wider financial system, and that includes the monetary policy response, for example. Then think a little bit ahead in terms of recovery and what that might be like, and Michael has covered quite a bit of that. And then I'll talk a little bit about our kind of internal response to the bank, which is obviously much wider than just the macroeconomic aspect, given that the central bank, as people know, has a very wide mandate, including for supervision, regulation and consumer protection. And so on the next slide then, I've just tried to summarise some of the macroeconomic effects. So recognising what I said there, that this is fundamentally different in nature and scope to the shocks that we've seen in the past. And the containment measures, those the broad economies worldwide. So on the next slide, Mark, if you can, thanks. And the governor published a blog there the other day, and I mean, he talked a little bit about some of that differences in what we've seen in the past. So even if you compare what's happened to kind of shocks that happened during natural disasters like earthquakes, or shocks that happened to the economy during, for example, it's a very different effect. It's kind of putting the economy on pause or bringing the economy to a complete standstill. So of course at home that's brought kind of widespread shutdown of businesses and a loss of many jobs, or these jobs which are being parked where people aren't going to work but maybe continue on the payroll of their employer. So I suppose in thinking about the recovery and trying to minimize the long-term economic effects, what we're trying to do in the bank is really understand what's happening right now, particularly how different sectors are being affected, which sectors need support most, and which areas kind of support each other. So in thinking about that, and given that I suppose such that there have been around understanding this kind of unprecedented effect, kind of work that we've been doing, which is on the next slide, if we can move them on. Looking at scenario analysis, the next one again after that, sorry Mark. Looking at scenario analysis, looking at sectoral analysis, as I said, looking at these real-time high-frequency indicators that we're trying to get, like payments data that might have this slide and a number of other pieces. A lot of market intelligence, so talking to firms, talking to representative bodies, talking to multinationals about what they're experiencing, and then also, I suppose, learning from international organizations. So if we can go on, I think it's 2 more slides, so not this one, not the next one. Yeah, this one, perfect, thanks. So this slide touches on some of the material that we published in our quarterly bulletin, which was out this day last week. I mean, I think this was a very unusual publication for the bank in terms of the unprecedented nature of the work that we had to try and do. And the bulletin is basically entirely about our analysis of COVID-19. So a very different bulletin to that which we would have been, I suppose, planning a number of months ago. Of course, given the level of uncertainty, we didn't publish the normal formal forecasts that we would normally publish. So instead, we tried to use a couple of different types of tools to provide some kind of estimates or some kind of analysis of how the crisis might play out. So we did use some of our existing models, but we used them more in a kind of scenario analysis way. And the chart on the right shows 2 of the scenarios that we published, one which is a kind of rapid recovery and one which is a much more prolonged recovery. And then we have some tables and so on in the bulletin which people can look up in terms of the kind of central scenario that we landed on, which was basically a 3-month period before the measures are rolled back. So that was our kind of central scenario. But on that basis alone, GDP would decline by about 8.3% in 2020. And our overall forecast for unemployment for the year, or our scenario analysis for unemployment for the year, was about 14%, but we could see unemployment as high as 25% in the coming months. In terms of looking at some of the sectors that are going to be most affected, our assessment is that the containment measures, in terms of the sectors that they affect most, about half of personal consumption would be covered by those sectors. So there may be this kind of deferred spending idea, but it's also possible that that consumption basically will not be replaced, and so consumption overall will contract significantly for the year ahead, possibly up to 10% was one of the numbers in the scenario, and that would obviously feed through as well into kind of domestic investment and so on, which would also affect the economy more broadly. And so on the next slide then, we had another type of analysis that we did, which was a more kind of sectoral view. And here what we were trying to do was estimate the effect of COVID-19 on individual economic sectors. And we think this approach is particularly useful in thinking about the sudden drop in output that we've experienced, so particularly helpful for kind of analysing that kind of sudden stop. Having said that, it is slightly crude and we had to use quite a bit of judgment in terms of the way that we modelled this through. And again, this is based on the containment measures being phased out after Q2. So essentially combining these assumptions suggests that overall output for 2020 could fall by just over 11%, with the annual decline obviously concentrated in Q2, when output would fall by about 30% if we annualise that. In terms of distribution, the sectors that are most affected are transport and recreation, which fall by about 36% and 34% respectively. So then on the next slide, talk a little bit about these real-time indicators that we're working on. And we have a number of other pieces of work that we haven't published yet, but we'll kind of continue this theme of trying to understand what's going on in the economy, trying to help commentators get some sense of what's going on. This particular slide is on job postings, where one of our economists has been collaborating previously with Indeed in terms of analysing what's going on in the employment market. And this particular piece of work was on modelling what was going on in Indeed postings over the last couple of weeks and how they compare with previous years. So in the sort of decline you can see there in 2020 is similar in terms of peak to trough of the decline that we would have seen over the whole period of the last crisis. So I suppose the key message here is the sudden nature of that stop. And the data also include comparisons across country, which I think is helpful in helping us understand, how we might compare to some others. It's important, of course, to emphasize that these are kind of the first round or direct effects. It I think can be expected that other occupations and other sectors will experience weaker labour demand in the future as the shock kind of ripples through supply chains and the economy more generally. And then, of course, we'll be able to see data like the CSO Live Register and so on, which can also support some of this analysis. The next slide then is the retail card payments chart, which Mike already mentioned. So in the bank, we collect data on use of cards, both in terms of use of ATMs and in terms of debit and credit card spending. And I mean, you can see the chart there, and all of the material is published on the website. But I suppose overall, one of the messages from the data is that retail card spending, both at point of sale in terms of debit cards and credit cards, declined by 27% when compared with the first week of March, and cash withdrawal amounts have almost halved. So in terms of cash, actually, we are a little bit unusual to some of the international evidence. So in a number of countries, and there was some coverage of this earlier in the week, in a number of countries, withdrawals of cash have actually increased quite significantly. That hasn't been the case in Ireland. But these data, I think, are helpful in understanding not just the kind of card usage, but also what we can see about expenditure and where that expenditure is happening. And we would intend to keep publishing this, as I said, to help people going on see what's going on in the economy more on a real-time basis. So on the next slide then, I mentioned that we're also, I suppose, talking a lot more to people. I mean, clearly that's part of what we do all the time, but we are also trying to get a more qualitative analysis of what's going on. So we're talking with a lot of industry representative bodies, IBEC and ISME and so on, firms, some of the people on this call and other kind of experts. We're obviously, from a supervisory point of view, heavily engaged with the firms that we supervise, but the intelligence that we can get from the firms that we supervise is also helpful in understanding what's going on in the real economy. We continue to collect and analyse a large amount of data, and we'll continue to publish that to hopefully help keep people informed, as well as informing our own kind of policy choices. So on the next slide then, maybe to talk a little bit about some of the kind of international dimension. I think a very important issue for the bank is that we don't operate in isolation. So we're part of the Euro system, of course, from a monetary policy perspective, but we're also part of the kind of wider international economic community. People will have seen media reporting on the IMF scenario analysis and the IMF World Economic Outlook, which was published earlier this week. And the spring meetings of the IMF are ongoing in Washington at the moment. And I think it's obviously an important part of the analysis for us as a small open economy, understanding what's going on in the rest of the world. And the IMF assessment is that there will be a global contraction of about 3% this year, and obviously a very different scenario in their country by country analysis versus before the pandemic. I think for us as well, thinking about this global perspective and the Irish economy being a small open economy is particularly important in how we think about the recovery, because Michael mentioned there the different paths of recovery that might be ahead, whether they're V-shaped or U-shaped and so on. I think one of the issues for Ireland is that even if things get back to some degree of new normal, or whatever we want to call it here, given our dependence on other countries, if the pandemic persists in the US, for example, or in other parts of Europe or the other parts of the world, it could have a big effect on the recovery here. And the recovery may also come and go a little bit, because measures may be reduced and then brought brought back into place, and this might bring a kind of ebb and flow or more W-shaped kind of recovery into the future. So these are some of the uncertainties that face us all. So on the next slide then, thinking a little bit about policy actions. So what have we been doing in the central bank in terms of taking action? I'll go through each of these. So this monetary policy first, in terms of being part of the Eurozone and the Governing Council decisions. Macroprudential policy, I think, has been an important feature of our response, and I'll talk about that. A little bit also about microprudential policy. So people will have heard about the freeing up of bank capital, either the CCYB or also at the level of individual banks. Payment breaks and the central credit register is another area we've been working on, and then the sort of resilience of supervised firms from an operational point of view, but also from a financial resilience point of view. So on the next slide, we just go over the monetary policy actions. So I suppose a big part of the focus of the monetary policy has been trying to retain these accommodative or supporting financing conditions for all sectors of the economy. So really trying to make sure that the measures that we take support the real economy at this time. So the pandemic emergency purchase program and a number of lending operations that we've put in place are basically put there to kind of safeguard liquidity conditions, protect the flow of credit so that firms and businesses and households can still have the credit that they need, and particularly I think to prevent a pro-cyclical tightening of conditions. So the additional asset purchases that we will do for this year, government bonds, corporate sector bonds, etc., will be a very substantial amount in both real terms, in monetary terms, but also in terms of euro area GDP at just over 7%. And then these targeted lending operations, the so-called TLTRO, targeted long-term refinancing operations that the banks can borrow under, provide significant capacity for the Irish banks to borrow. And they are obviously incentivized operations where the pricing and so on has been designed in a way to incentivize banks to use them and then to lend that money on into particularly the business part of the economy. And those measures obviously apply across the Eurozone in its entirety. So on the next slide then, a little bit about macroprudential policy. So as people know, this was sort of one of the big policy responses after the crisis to try to strengthen the resilience of the financial system and prevent kind of re-emergence of issues into the future. It's an area where the Central Bank of Ireland has been very active over the last number of years. Our borrower-based measures on the mortgage lending are part of this framework, and the counter-cyclical capital buffer is a very important part of this framework, which is designed to make sure that banks build up capital in good times that can then be released in more difficult times, again to deal with this idea of pro-cyclicality or to try and prevent something happening that amplifies the shock. So we had activated the CCYB at 1% a number of years ago, and it had been phased in and so on, and we decided very quickly after the recent issues emerged to release that buffer. It releases a significant amount of capital across the banks, which they can either use to support lending or to absorb losses. In addition, people will be familiar that banking supervision for the Eurozone is now operated on a pan-Eurozone basis through the single supervisory mechanism. So obviously at the central bank, we are part of the single supervisory mechanism, and their work is focused on the supervision of individual banks and on an individual bank basis, as well as this kind of macro-prudential basis of CCYB. There's also further flexibility given around Pillar 2 capital requirements, again to make sure, I suppose, that banks have capital to either continue lending or to absorb losses. Now, an important caveat on both of these capital aspects, both at the micro or individual firm level and at the macro level, is both ourselves at the Central Bank of Ireland and the ECB have made very clear that these releases are not to be used for dividend payments or payments of bonuses or anything like that, but rather to support lending to both households and businesses, and that has been publicly stated in terms of our expectations to the banks. So on the next slide then, thinking maybe a little bit about the recovery. I mean, clearly back to what I said at the beginning, it's a public health crisis, so the path of recovery really depends on the path of the virus, both domestically and globally. Of course, how and when the recovery happens depends on the extent to which scarring happens. And this issue particularly, I think, which we want to think about quite a bit more, about the idea of kind of precautionary behaviour. So is it the case that these events, I suppose, make people very precautionary about consumption, for example, increase people's focus on on savings and so on. Our dependence on the global economy, I mentioned already, is going to be a key focus for us, particularly if other parts of the world either emerge or don't emerge from the current circumstances, or if that happens at different speeds. Our past experience in Ireland is that our trade composition, so a large part of our trade, as you know, is kind of medical, pharma, IT and so on, could act as a buffer, as happened in the last crisis as well. But again, there's some uncertainty about that. And I think in terms of understanding the potential for long-term scarring, we really need to understand the different sectoral effects and the areas that need kind of very targeted support. So then just thinking briefly before I wrap up about the central bank's kind of wider mandate was on the next slide. We are obviously the regulator, we're the supervisor, we have a consumer protection mandate and so on. And I think our focus over the last number of years has been trying across all those different elements of our mandate to rebuild the resilience of the financial system after the last crisis, and to have a strong consumer protection framework through our consumer protection codes, the code of conduct on mortgage arrears and so on. In terms of our own internal work, we've established a COVID-19 crisis response task force, which covers all of these aspects that I've been talking about in terms of the macroeconomic effects and how they feed into our thinking about the firms that we supervise, for example, whether those firms are banks, credit unions, the large funds industry have in Ireland, or insurers. We are thinking about how those macro scenarios may play out so that we understand the effects on liquidity in the financial system, that we also understand the resilience of supervised firms from a financial perspective, that we think about recovery and resolution and so on. So all of the different aspects of our mandate, I suppose, and how this crisis may affect those different parts. That includes, as I mentioned earlier, some of the work that we've had on payment breaks, which has been subject to much public comment, and on areas like your credit rating on the central credit register and so on. So I think in the face of what is a very unique challenge, the breadth of the bank's mandate across all of these different dimensions is actually a real strength. So I leave it there, Stephen. So thanks very much again for the invite, and happy to take any questions later on. Thanks.
Thank you very much, Sharon. That was great. Apologies, anyone, if there were slight audio problems at the start of the talk. Like I said at the very start, we're experimenting here, and we'll do our best. Can I also remind everyone that you can send comments and questions through the private chat to me, and then I'll put them to the speakers later on. Okay, thank you very much again for that, Sharon. It's remarkable the amount of work that is being done by so many people remotely, you know, in their spare rooms you know, it's very, very short notice. So thank you for that. Can I move on to our final speaker, please, Beata Javorcik?
Thank you very much for the invitation. It's a pleasure to be joining this panel and sharing with you some observations about the long-term consequences of the pandemic, and in particular, taking a more global perspective, which I think complements quite well the earlier presentations. Now, we live in times of unprecedented uncertainty, in times of unprecedented change. History is accelerating in front of our eyes, and the world post-COVID will be quite different. We do not know yet what it will look like, but I think it's worth to already stop and start thinking about what it will be like to live after the pandemic, because the choices we make now may affect what will come next. So let me start with globalization. COVID struck at the point when globalization was already weakened. It was weakened by trade wars between US and China. Global trading rules have become less strong. The appellate body that resolves disputes at the World Trade Organization stopped functioning. So COVID strikes against this background of uncertainty about the future of free trade and trade policy. Very early in the pandemic, we have seen disruption to supply chains. At the initial stage, Hubei, just one province in China, which accounts for less than 5% of GDP of China, but which is a manufacturing hub for high-tech industry, for automotive, and for pharmaceuticals. The lockdown of that one province in China reverberated through supply chains all over the world. North America, Asia, even a car factory in Serbia had to close because of lack of supplies. Now, this is not the first time we have seen disruption to supply chains. If you go back to 2011, earthquake in Japan around Fukushima caused disruption to Japanese producers of cars in the US. But there wasn't much reaction back then because everybody knew eventually those plants would come back online, so there was no point making changes to supply chains. But this time is different. It's different because we have two shocks, not one. We have shocks to trade policy as well as a shock that exposed how much we are dependent on China, how global suppliers are concentrated in China. It's also different because these shocks are likely to come back. Uncertainty about the future of free trade has not been resolved. And if you believe climate scientists, we are going to see more of adverse weather events, more of new diseases emerging. And in my view, this is going to lead to rethinking of global value chains. Currently, global value chains are designed to optimize the cost. And that works like magic as long as there are no shocks. Basically, for the supply chains to work well, you need all parts of the chain to work like clockwork. We have seen that once there is a shock, everything breaks down. So going forward, I think there will be more focus on resilience. Firms will want to build in some redundancy to supply chains. There will be some move away from holding near zero inventories. And I think that credit rating agencies are going to place greater weight on resilience when rating companies. Now, what does it mean for us? Well, that means that there may be some reshoring, some of the production may be coming back, and that's going to be possible thanks to automation, which will make the importance of labor costs much lesser. Also, this reshoring, this reorganization of supply chains, this building in resilience will mean that suddenly the cost will become greater. May have potentially impact on inflation. The second question on my mind is, will globalization be rolled back? Sorry. Now, during the financial crisis, a lot of people were worried about it, and actually it didn't happen. It didn't happen because the ability of countries to increase tariffs was constrained by the WTO commitments and by preferential trade agreements. So typically countries charge lower tariffs than the tariffs they have committed to at the WTO. But what's called tariff water, and the difference between the actual tariffs and bound tariffs, not all of it is meaningful policy space because a lot of this difference is constrained by preferential trade agreements and is constrained by the fact that under some tariff lines, they are so large that they are already prohibitive, there are no exports. So there was no actual increase in tariff rates during the financial crisis. Now this time the situation may be a bit different. The World Trade Organization and its rules have been weakened. The US-China war is being fought outside of the WTO framework. We have seen export restrictions on medical supplies, even within the European Union. Now, as currencies of some developing countries have plummeted, these countries have introduced export restrictions on agricultural products. They were concerned about inflation, food price inflation domestically, so they restricted the ability of their own producers to export food. Now, at the moment, there is no reason to think that there will be food shortages globally. However, these export restrictions may have negative long-term consequences because they may fuel protectionist sentiment. They may be used by anti-globalizers to justify introducing protection in order to, on the national security grounds. And I think you already can hear some of these voices. And what's particularly dangerous is the fact that in 2018, US has paved the way to using national security exceptions under the WTO agreement by introducing tariffs on its imports of aluminum and steel and justifying them on national security grounds. So whether or not the globalization will be rolled back, I think it will depend on what the European Union will do. I think at the moment, the US is not particularly interested in supporting global trading rules. So I think we need to count on the EU to provide strong leadership. And this is very important because as we enter the recovery stage, we will need open markets, we will need free trade to stimulate global recovery. There are other issues that have a global dimension. What will happen to international travel? No country is an island in the world of COVID-19, and we are only as strong as the weakest link. Unless we close the borders completely, we are always open to the possibility of importing infections. So somehow we will need to think about a system of perhaps certifications which international travelers will carry to show that they are not bringing the virus. And for that, we will need international cooperation. We will need to step up with global monitoring and early warning systems, monitoring of potential new outbreaks. And it doesn't augur well for the future that the US has just withdrew from the World Health Organization and cut its funding there. In the post-COVID world, we will need to think about resolving the high debts that will be accumulated, particularly by developing countries that do not have the full space to react very well now to the crisis, so they will need to borrow to do that. And of course, developing countries that in many cases will be hit harder by the COVID pandemic because of their less advanced health systems, they will need more help from the international community. But it's going to be difficult to make the case for foreign aid in the post-COVID world, as all countries will have just emerged from an economic crisis. So I think what we need is another Bretton Woods conference to think about the post-COVID world. During the World War II, countries convened in Bretton Woods already almost a year prior to the end of the war to think about international cooperation and economic order after the war. That's what needs to be done now. We need to start thinking about what kind of world and what kind of an economic order we want to have in the post-COVID world. The next issue I want to turn to is climate change. The COVID pandemic threatens our efforts on the climate mitigation change because COVID has basically everything, including the climate action. In the ancient times of January 2020, headlines of newspapers were dominated by climate mitigation efforts. This topic has completely disappeared. And there is a danger that we will take a pause in the drive to green transition. But of course, COVID also creates opportunities. Speeding up remote work, the transition to remote work means there are fewer emissions. Perhaps going forward, there will be less business travel, which also means less emissions. But there are things that could be done on the policy front. So for instance, I think we need to signal strongly commitment to green issues, because as these global value chains are going to be rearranged, this strong commitment will change the way in which they will be set up. Now, if you were reading headlines in January or if you were in Davos, you would think that all firms are on board with climate change mitigation efforts. That's actually not true. In the countries where my institutions, the EBRD, operates, that's Eastern Europe, former Soviet Union, Southern Mediterranean, a survey of firms shows very little awareness of the need to do anything on the climate mitigation front. So here you see summary statistics from answers when firms were asked, if you do not adopt energy efficiency measures, why is it? And basically, 2/3 of firms say, we do not invest in improving our energy efficiency because this is not a priority for us. So that shows that there is very little awareness among firms on the need to do anything. And as I mentioned, because climate change is likely to lead to more extreme weather events and perhaps new disease outbreaks, now is the time to talk about this. And now is the time to build public support for action. We know that people who have experienced flooding of their homes are much more friendly to climate mitigation efforts. Similarly, our research at EBRD shows that firms that have experienced monetary losses due to extreme weather events are much more likely to have green management strategy. Now, of course, we can also tilt our spending to green. So what do I mean by this? Well, at this point, immense amount of money is being spent to counteract the economic crisis that has been caused by COVID. And more money will be needed and will be spent during the recovery phase. And this creates an opportunity to tilt to green this spending and turning the economic stimulus into an accelerator for a low carbon economy. Now, note that I use the word tilt. I'm not advocating taking money away. I'm just advocating shifting the focus slightly, nudging firms to better behavior, encouraging disclosure, encouraging public scrutiny, building up the case and public support for climate change. Now let me turn to remote work. Remote work is probably here to stay. This will have an impact on the real estate market as there will be less. For office space, this may boost to some innovations on the IT front as firms will want to monitor what their workers are doing at home. It may have implications for our mental well-being. There are a lot of people who enjoy working from home, but there are a lot of people who actually don't cope with home working very well. So we may be facing an epidemics of loneliness in the future. But from the economic point of view, there is another implication that may be more interesting. It's amazing how fast we adjusted to remote work and how much we interact with colleagues, whether in the same place or in different place, through Zoom, and how well we are actually managing to exchange ideas, not being in the same physical location. So it's quite possible that it will become less important to live in a large city, to work in a large city. Now, large cities, large metropolitan areas are very appealing to workers because that's where new ideas are being created. That's where creative types interact with scientists and come up with plans for startups. But if we are able to interact well remotely, perhaps it will become less important to be in the place where all the action is. Also, as there is more remote work, we may want to have more space at home. And that means that secondary cities can suddenly become more attractive places to live because they offer cheaper real estate and you can interact remotely almost as good as before you could interact by being in a remote location. And we know that metropolitan areas are disproportionately rich and have been doing very well over the past decades. So for instance, on the left-hand chart, you see that GDP per capita in the capital city is 3 times as high as in other places in France and double of the other places in some Eastern European countries or even in the UK. Moreover, you see that over the past 2 decades, capital cities have been increasing in terms of their importance as a share of GDP and population. And this boost to secondary cities may have implications for spatial inequality. It actually may lead to a decline of spatial inequality. And because spatial inequality is often a source of discontent that's exploited by populists, that may have an impact on politics. Moreover, if the concentration of polluting or carbon-intensive industries in particular locations is one of the key obstacles to low carbon transition, this decoupling of the place where you work and where you live should make low carbon transition easier. The final area I want to focus on is the importance of the state. We have already seen a trend towards greater intervention from the state. And I think this trend is going to be accelerated. The COVID pandemic has exposed weaknesses of the gig economy, of 0-hour contracts. And I think in the post-COVID world, we are going to have a conversation as societies about labor market rules. I think there will be a pressure to provide more protection for workers. I mean, in the past 2 decades, essentially firms have been shifting the risk onto workers. And I think we are going to see a reversal of that. I think citizens will expect more from the state. I think some of the ESG voluntary standards may be replaced by regulations. We may see some nationalizations as the state is propping up failing industries or companies and is taking a stake in that. The COVID pandemic will also have implications for populism and for democracy. We already see that in some countries, politicians are mixing anti-crisis response with politics. In some places, there's an open power grab, which is being justified by the exceptional circumstances. There is erosion of privacy. And it's unclear whether these 3 trends will be reversed in the post-COVID world. Now, what will happen to populists? Well, there is one scenario in which the outbreak will expose incompetence of populist leaders. They will no longer be judged on how catchy their slogans are, and they will be judged on how well they dealt with the crisis. It is possible that the pandemic will restore trust in experts, that more decisions will be depoliticized and delegated to technocrats rather than being left to politicians or popular vote. But of course, there is another possibility. There is a scenario where propaganda will be able to counteract failings of incompetent leaders, and we will move towards more populism rather than away from it. So there's a lot we don't know. One thing that's for sure is that there will be changes. The world is at the crossroads, and whether it will go towards the optimistic scenario or the pessimistic scenario, we don't have a full control over that, but we can try to shift the probabilities. Thank you.